Perfect.
Pressure is mounting. All right, guys. Let's go ahead and just get started. I'm Matt. Nice to see some new faces in here. I guess see some old, wonderful faces too. Obviously, some of you know Sarah, some of you know Mainstay, some of you know me. Whichever way, these three powers are combining on this deal, and that, in my opinion, gives us a lot of potential. That's what we're excited to share with you guys today. And it's all going to be based on this, the Long Lake Resort. I think a lot of what I'm going to explain to you next is all in the slideshow, so I won't overshare, but I guess if there's anything starting off that Sarah or any of the board want to say, now is your time. Otherwise, I'll start with the slide.
You got it.
Cool. All right, here we go. Here's our disclaimer. Every investment opportunity has one of these. There's estimations, there's expectations, there's likelihoods, and then there's reality, right? We do have a pretty solid gut feeling this is going to work out well. This is what we've used to justify our last 8 years of purchases. Largely 90-something% are all making money. Give or take like an occasional eviction from a long-term tenant, or like an occasional issue from a plumbing challenge in a short-term situation, or even vandalism. We've seen it all. We've encountered all these issues. Should that scare you? No. It just means we've dealt with a lot of situations where you have to adapt, figure out a way to make it still profitable and functional, right? So this disclaimer is very fun. I'm sure you'll enjoy reading every single word, but it's available for you. Read it at your own convenience. So we're going to kind of go over a few things: the executive summary, general partner introductions, short-term rental market statistics, property introduction, financial overview, and then next steps, how to invest with us. So the property details. Located on Long Lake near Hale, Michigan. It's actually in two different cities, one property line away from each other. They actually adjoin. It's kind of interesting, but same lake. So Long Lake City and Hale City. Combined, or these are two different purchases. It's going to give us over 300 feet of lakefront frontage with multiple docks and boats included. Two side-by-side properties. It's going to be a total of 12 units, once functional. It's a value-add opportunity in an attractive small market. I don't cover all the value adds in this. I'm going to go over what we expect to do and what we feel confident about discussing, but there is additional benefit on this deal that's not going to be disclosed in depth here because we're still learning it. It's going to be a combination of potential boat rentals, potentially adding additional units like tiny homes, maybe doing some kind of yurt. If you're familiar with a yurt, there's a lot of opportunities here. We already have Sarah, actually, her family, they just started their first B&B project on the same lake. So we've already been building people around here to help cultivate this property. Generally speaking, Hale is about 2.5 hours north of Detroit, Ann Arbor. Again, it's about a 20-bed unit of the 12 units. 7 already turnkey. The mix is 5 1-beds, 6 2-beds, and 1 3-bed. Purchase price is about $1.17 million, about a $400K estimate on the renovations and repairs, furnishing. Estimated annual revenue could range, we're expecting between $420 and $570. Expenses of about $240. Properties planned to both generate quarterly dividends and appreciation over a 5-year deal. We're looking for like-minded limited partners and offering 7% as a preferred return and 40% of all returns after 7%. We're going to dive into that a little bit further later on. I understand that might be new language for some of you, but it will make sense later. Okay, so who are the people that found this deal and have been working on it so far? Me and my wife, Sarah, and her husband, Ethan, as well. Great guy, by the way. I own and operate about 50 units, mostly in Michigan. I have an 8-unit hotel in California too, which has given me a lot of experience working in a transient market near Joshua Tree, and generally trying to figure out how do you find great contractors and furnish from a distance. It's been quite a learning curve, but we've been generally successful. And beyond that, my wife, who is a pharmacist, she just left her job. This is her first week as being solely self-employed, and she's onboarding about 6 units of Airbnbs right now. She manages about just over 20 right now. And then there's Sarah. Sarah, most of you know Sarah. Sarah's had experience all throughout the nation, working with another investment fund that's STR specific, short-term rental specific. She's had experience as an owner as well as experience as doing arbitrage in Texas. Sarah, if you ever want to jump in on this, you're more than welcome. But she's one of the first people to work with this STR fund. And now the goal is probably within the next quarter, we're hoping to establish fund after another continued proven successful opportunity like this one. Both of us are super hosts. We both have nearly just over 1,000 reviews between us. And then we're gonna meet our third part of the team, Mainstay Investments. It's a combination of 30 people, 5 people run and manage it. It's a board. I am one of the board members, actually. There's real estate brokers in here, agents, contractors, few people that have built some multi-million-dollar businesses. So we have a large variety of intelligence and application in business that I think we can offer to any business management moving forward. In general, and pretty much it was really, I think, less than a year that we acquired about 9 properties, and within 18 months, everything was up and running. About $1.5 million in acquisitions, using mostly single family as a portfolio and a couple multifamily. And generally, it's been going great. They actually have, I think it's about 800 reviews. They have 2 different accounts for this one, and they are also super hosts. So that kind of gives you a little background on the third party that is a general partner. So my wife and I are general partners. Sarah and her husband are general partners. Mainstay is general partner. There's 3 general partners. Why this team? Why do you want to work with this redhead guy, this lady from TikTok, and this team of Mainstay people? Here's why. Combined, we have over 1,500 reviews as super hosts. So we're not exactly new to this. Our combination of experience is likely top 2% in the nation if you combine it. Samantha and Sarah are planning to combine forces on their management style. They've been able to squeeze out higher nets than average compared to the average Airbnb in the area. That's largely because of their styling and their communication skills. So I have the utmost confidence in these 2 running all communication and management of the Airbnb platform, Vrbo, whatever we use, which we will be using both, to be clear. Beyond that, Mainstay has had to learn how to communicate with up to 30 people at once effectively and successfully to actually maintain quarterly payouts, quarterly statements, annual statements, K1s, whatever, to ensure that everybody is operating smoothly and has had good say and made excellent business decisions regarding all purchases, renovations, and challenges. So just kind of want to show you guys a couple of options, not options, of Airbnbs that we do own and or have furnished. Yeah, these links, they're finally working. I'd go through these later on if you'd like to, but I just want to show you kind of a quick little snapshot of what we have going on, because there's a lot of information coming up. So this is 4 here. Here's another 4. Again, a lot of these things are, in that 5-star range or dang close. And then, is that going? Oh, there we go. Okay. So here's a little brief history on STR, short-term rentals, Airbnbs. We like to call them STRs because Airbnb has become the Q-tip of the cotton swab, and we're not sure Airbnb will always be the brand that really describes us the best. So sometimes we use the word STR more commonly these days. So in 95, Vrbo started. Oh, weird. Okay, 95, Vrbo started. 96, Booking.com started. 2000s, HomeAway merger. Airbnb starts in 08. Gained more traction in 2010, and today STRs are booming. There's units coming on board literally every day. And simultaneously, there's been a retraction of some of the markets, some of the more saturated markets, particularly in the Sun Belt states, Florida, Arizona, Texas, California, things like that, because there's heavy saturation. But oddly enough, a lot of those same investors are targeting one state in particular. I can probably guess you all know what that is, Michigan. So that's kind of going to get to the point of why we're choosing Michigan as our #1 place to focus our time and energy. This is another handful of stats of why we feel like we're bullish on STRs in general. Feel free to review these later on, but generally you can see there's a lot of activity, a lot of growth in this investment model. So for you guys, here's the big idea. Goal is you as we refer to you as limited partners, investors. You would invest, you provide capital, you would be investing in a deal that we've already put up our capital and expenses on. And as the property comes to a close, what do? We get started on the rehab, the renovations, the refurnishings, and just general management. And after all that, it's generally a 100% aligned incentive. And everybody's going to win. That's the idea, right? So why the Midwest? It's quite simple. There's high demand, low supply. That's kind of what I was referring to in the previous slide. We're ahead of the curve and we know it. Generally, here's a good example. One of the first Airbnb, the first Airbnb I ever bought and ran, there was no data. This is back before AirDNA was even a real thing. It didn't really even exist because there just wasn't data. I said, hey, I don't know what this Airbnb thing is, but I'm going to give it a go. And I looked around, I said, I'm not 100% sure this is going to work, but I'm willing to gamble my furnishing and my vacancy potentially on this deal. And I went for it. And I went under the guise that I felt that the proximity to good schools, a good town, being close to the Detroit River, if you're familiar with Wyandotte, and just generally a part of the Metro Detroit area, I figured it had a good chance of being sustainable. Plus, there's a lack of hotels and motels in that area. And sure enough, it worked out, and that gave me my proof in the pudding to continue. And ever since then, we've kind of gone with that same approach. Every city, we're usually one of the first people to invest in there as an STR in Michigan. And we've come out ahead and usually set the pace for what a lot of people are trying to keep up with. And then, of course, Sarah had her very, very cool property up here in Bitely, a city I would skip over any single day, but she saw a vision and she set the tone. Her ROI destroyed everybody on her massive pond lake that she's on. Sarah, if you ever want to talk about that, you're welcome to jump in on that one, but that was a really special situation. Okay, so the process, generally speaking, our goal is to find, underwrite, tour, and close on a viable STR property. That's already been put in motion, right? We haven't closed, but we're past the inspection stage. We're currently at the appraisal stage and underwriting. Two, we spend more time than than our competitors understanding both Airbnbs and guest prioritized experiences based on B&B. So when it comes to amenities, feel, look in terms of professional photos and staging, those are all things that we're always considering when we do put these projects together. Three, we got our boots on the ground. Sarah and I are not afraid to jump in a car and go hunting for a good property. We typically do that nearly every week. Sarah does that sometimes a few times a day. She travels state or states in a single bound per week. It's pretty impressive. And then our favorite phase is when we stop spending all this money to get this thing up and running, and it simply is making money. We're managing the pricing strategies to ensure that we have maximum occupancy at the best rates possible. So here, now we're going to get to the property. The general purchase price is about $1.17 million. Again, we kind of covered this, 420 to 570 for the estimated annual revenue, and we're expecting a launch date of about January 15th. In this photo, you see the property that we call Long Lake. It's in Long Lake. This is the property to the right if you're on the lake. And yeah, that's pretty much all. And this is actually a picture from the other property in Hale. This is actually looking out at the lake. In here, you have two different links to each property, Long Lake and Hale. You are more than welcome. We're going to make sure you all have the slide deck so you are able to access this later on. But again, here's another handful of photos. One thing that we really like about these properties is that in conjunction with each other, they actually are quite beneficial. So what's interesting is property on Long Lake, I call it the J building sometimes because it's kind of shaped like a J. It's gray, I guess. That property, the net the purchase versus the income is actually higher than the Hale property. And generally, if it was about just buying one or the other, you'd probably target this. Now, the issue is this one actually has 2 docks, and it came with 2 boats. We were able to negotiate the boats in with the same purchase price. Now, the issue is, what do you do in the winter? You got to get those boats out of the water and store them. Here's where Hale becomes beneficial. Hale actually has a 30 by 40 oversized garage that has just enough room to store those and some other things, because we intend to buy kayaks for both properties and also rent those out. These are all ancillary forms of income that we intend to use to generate money for this property and this project. And Long Lake in general, it's a gorgeous lake. Like I mentioned, there's already another property that we're starting to operate on it. And what else do I want to hit on this one? I think that's about it. Yeah. Okay. Go to the next slide. So property features combined, buying both of these properties, we're going to be just over 300 feet of lake frontage combined. We're going to have large storage for boats and kayaks. There's going to be opportunity to expand. Again, there's so much land that we could do more yurts. Maybe we could tear down something that we don't like. It would probably be the post office that comes with it. It's currently operated as a 1-bed, 1-bath unit. It's not a huge value. It's not great. And if we have an opportunity to convert that to maybe 2 or 3 units on that same little strip of land, we may do that. But for now, we're going to get this thing up and running, prove that it's functional, and then we can talk about a phase 2 of development later on. Again, other income generating opportunities exist in boat rentals. We're going to be buying hot tubs, games, kayaks, and other enjoyable features. Currently, it's zoned commercial at both properties, which is going to allow an opportunity to, when it comes to the appraised value and even the sellability, to approach it from an income approach. Some people may know this, some may not, but residential properties, they don't get the income approach to value for appraisals. Commercial properties do, however, and that's where the benefit of moving from our residential focused portfolio to commercial will have the most impact. And right alongside this, literally to the right, if you're on the lake, of the Long Lake property, it's been $1 million producing restaurant, bar, and grill. A new developer bought it this year, and their intent is to tear that thing down and build a 2-story version of it. I'm presuming they intend to double the income of it. And honestly, for it to have made $1 million a year as is, it's not the best place, but it's been a time-old classic for people to go to. It's been the #1 place to visit. But now I think that they're starting to attract a higher end of clientele, people that will be interested in really staying there, really, enjoying the scenery, maybe probably pulling up to boat, via boat to, boating up to it. And it's going to create a whole new atmosphere and a lot more enjoyment on this lake. Yep. And then let's see, renovations. I realize this may be a little small on your screens, but the key number is pretty much at the top, $400,000. What that number represents is all of the rehabs, renovations, and furnishings that we're anticipating, as well as some of the holding costs in getting this property up and running. And in fact, what we did is we took a high and low of every number from the range we expected. Once we got that average number of that high and low number, we then added an additional 10% as a buffer to make sure we weren't undervaluing the potential expenses. And that's what that number is. It's the average of all those high and low numbers plus 10%. So I think that we have a pretty comfortable approach to how we're covering the downtime of the seasonality entering winter. And it's going to be very cold the moment, but by the close date, we're expecting to close as early as the last week of November, and probably no later than the second week of December. That's kind of the ballpark range, depending on how the appraisal timing comes in. Where's the renovation money going? Furnishing and updating all the units. We're going to convert the 2 retail spaces to make 2 more 1-bedroom units. We're going to rehab the post office and single family into a more desirable and functional home. Additionally, we will fix and improve the boats and buy kayaks for more lake enjoyment. We're going to be adding surveillance and deferred maintenance repairs, because, well, as well as doing deferred maintenance repairs, as well as grills and patio furniture, exterior paint, and signage. Cash reserves for the slow season and conversion time as we enter the winter period. Okay, here's kind of a snapshot of what the holding costs Over here, we have mortgage info. We're factoring 25% down payment that has been confirmed. We're hoping to maintain an 8% mortgage interest rate. P&I, our principal and interest payment is about 64.39. Pulling that down here. Taxes per year, we calculated at 16,000. This is a pretty conservative number. It may come in lower. Insurance per year, we need to double check this number, but we're ballparking 8,000. I think that's a pretty conservative number, but we should have finite numbers probably next week. Mortgage monthly payment will be about $8,400. Coming back over here, this kind of gives you an idea of where the cost to close will come in. How much cash do we need to perform this deal? So down payment and closing costs, we're factoring in at 336. Improvements using the previous slides information is 255. We're expecting nearly 100,000 in furnishing. Kind of a holding cost of 52,000 to make sure in case something goes particularly slow or wrong, we have that available to us so we're not in the hole. There's an acquisition fee of 1.5% for the deal. And then the non-mortgage related costs are 430. All that combined is 767,000 and a total loan need of 877. So the total project, we're looking at about $1.6 million worth of things. And lastly, the holding costs. So here's the mortgage costs. We already factored that in on the other couple. Here's our expected utilities. We're expecting about $200 per unit. And then the lawn and snow, about 120 between the two properties, about $100 in supplies per unit. The total of nearly $12,000 monthly, annualizes 147. Maintenance expense of 2%. Property management is 12%. Annual expenses is 237. And yes, Elizabeth, go ahead.
Hi, actually, this is Mike. I'm Elizabeth's husband.
Hey, Mike.
The FTG closing costs, what is that exactly?
The mortgage closing costs, we're expecting
Oh,
about.
it's the mortgage closing. Sorry, I thought it was like Mainstay Group. I thought you guys. I thought it was like a 6.5% fee. So sorry, I was.
No problem. No, good question. Good. Yeah. So some people's acronyms are different, and that's actually a pretty good guess. I like that. Hopefully that cleared it up. Any other questions so far? I know some of this is fast, but it's because there's so much. I don't want to exhaust people either.
This is great. This is great. And just the property management on the bottom right cell, the 12%, is that if when you're holding it, there's no revenue, right? So there's no, I guess what's the 12% of if there's no revenue during holding?
Good question. So that is the fee that we're paying Sarah and Sam to run and handle all inquiries, all management, things like that. So as like in our first couple months, there's not going to be a whole lot of profit because obviously we're going into slow season. We have multiple down units. They need to be boots on the ground up there on site, getting everything together with the contractors, buying all the new furnishings, building it. Getting it all set up. So that's effectively where that's going to during that period. Of course, it's all based on revenue, right? So if our revenue is low, that property management expense is low too. But as it kind of carries up and catches fire, once we hit summer, that's when it's going to be, that's when you're going to see the fruit of all these efforts. This first quarter, up to probably June 1st, there's a lot of parts kind of moving until June 1st. June 1st being something I'm going to get to in a second, which is the seller of the Hale property. Part of the negotiation that we had to do to go from buying 3 of her units to buying 5 units plus the garage was we had to allow her to stay until June 1st. Based on my conversation with them today, I think they won't even stay past Q1. It sounds like they actually are at inspection for their home purchase today. The inspection's over for today now, but that tells us they would possibly like to be out of that house in 3 to 6 weeks. So we may actually get access to the largest part of this project, which is going to be a 2-bed we're converting to a 3-bed. And that will be, how'd that happen? I think somebody.
Sorry, I pressed the button accidentally. I don't even know how I did that. So, sorry about that.
You have impressive powers. Okay. No, it's all good.
I think he was asking, like, okay, if the property management is part of the holding cost, how are we calculating the property management when when we haven't earned yet. Does that
I
make
see
sense?
what you're saying.
Yeah, yeah, Sarah, that was the question, but I appreciate all the detail about the,
Yeah, there's a lot of details coming. It's kind of a complex deal. But generally that was factored under the assumption that we're going to be doing, I think the 420 to 570 income. So that's based on the assumption. So I just took an annualized version of that, and you're going to see the income assumptions next.
got it. Okay, so that's not cash out during the holding period. That's just
No,
your
it's not a
placeholder.
lump sum. No, it's going to be kind of like maybe our first month we make $100. Let's give them $12 for it, you know. But you know, obviously our second, third, and eighth month will be very different.
Of course. Okay, thank you very much. Sorry for
Welcome.
appreciate the call. The answer.
Don't hang up. Don't hang up. Okay, 1 second. Let's see. Okay, so comps. Sarah and I have been. Can I get rid of that little red thing? I'm sorry. Oh, wrong button. So I don't know if I know how to get rid of that thing. Do you? Anybody? It's okay.
No.
Okay. All right.
So
So
all else fails, hit Control Z. That's what I do.
we'll control. I'm afraid.
It's gone now on my end.
Oh, it's gone.
Yeah,
Oh,
it's gone. It's
now.
gone. It's
Okay.
gone. It's gone.
Cool. Yay.
Good.
Thank you, whoever did that. Okay, so the comps. Now, this has been a big question. This is something I do want to kind of get a little bit more detailed on. There are not, and Sarah, I'm definitely gonna pull you in on this one. I hope you're ready.
I'm so excited to talk about the comps.
You know what? You know what? There you go. It's yours. Go for it.
Okay. So if any of you sat through the last investor pitch that we went through, I repeated myself over and over again about how difficult it is to comp Michigan properties in comparison to the rest of the US, or a lot of the US. I've worked in so many markets in the US that are way more popular than Michigan is, right? I mean, you look at like the Gatlinburgs, the Scottsdales, the Floridas of the US, and it's very easy to like look at something that's nearly a copy and paste of what you're creating, so you know exactly what to anticipate as you're bringing it on the market. That's not the case in Michigan at all, because Michigan is so underdeveloped. So there's just not the same amount of good design, good photography, well done, hotel-esque Airbnbs for you to take a look at and say, okay, let me spy on you, let me see what you're making. So over the last couple of years, since we've been in the Midwest, we've gotten kind of a system down on how to comp properties, and it's so far we're always undershooting it. It's just one of those things where, you know, when we have a property that we're walking into, we're looking at the standard that the Scottsdales and Gatlinburgs and Floridas have, and we're bringing that to Michigan and watching how it performs in Michigan, and it's exceeding our expectations. So on the front end, the numbers that we're pulling from aren't exact matches. There is a little bit of wiggle room in how we calculate it. But so far we've proven ourselves right every single time. So a big reason why we were looking in this area in particular is because STR Insights said that this area in Michigan specifically is the most profitable small market. And for us, we gravitate towards small and medium markets because the competition levels are even lower than per se maybe in the heart of Detroit or around Grand Rapids or some of the more popular areas in Michigan. This lake in particular has 30, or this area in Michigan has 30 Airbnbs, and 22 out of the 30 Airbnbs are 3-bed, 2-bath listings. So for this particular property that we're looking at, we're really filling a gap that isn't already oversaturated in a market that's proven to be robustly growing over time. So this first property, if you look all the way on the left, the cozy cottage with breathtaking views, this is a 3-bed, 2-bath, holds 8 guests property. It doesn't have professional photography. It doesn't have professional design. It doesn't have a hot tub. It doesn't have any added amenities, and it's still bringing in $120,000 annual revenue. And it's not even listed for 365 days of the year. It's close, but not quite. So for us to look at this, when I invested in a property on the same lake before we found this multifamily, mine is also a 3-2. And I was very specifically looking at this property and being like, I know I can make 120K because I can beat it on so many corners. And so when we're looking at this multifamily, there aren't exact comps, right? I mean, on Airbnb, there aren't a bunch of motels for us to look at. There aren't a bunch of standalone 1-1s to look at. So we're taking a look at these, we're pulling as much information as we can, we're understanding what's working and what's not, and then we're applying it to this property. We also are paying close attention to the 2 properties over here on the right. The the Island Cove properties. It shows up as two separate listings on AirDNA. One is the VRBO listing and then one is the Airbnb listing. But combined with those two listings, it's making over $200,000 a year and it hosts 20 guests. So we've got kind of two strategies when we're looking at this multifamily. We want to create two separate ways to book this property, one of which being targeting huge groups, right? Huge groups that are 20 plus people who want to rent out the entire multifamily situation. And typically with those guests, they're booking a lot further in advance. So we want to open up that calendar to 9 to 12 months out, renting it all as one single unit to one party, targeting them first. And then when we're within 3 to 4 months, we're going to open it up and we're going to rent them out separately, just like a hotel. So we're paying attention to both big properties on this lake and small properties on this lake to really start understanding how they're performing. And this property on the right that's holding 20 people, again, doesn't have any of the amenities that we're going to add. Of course, it's on the lakefront, just like ours is, but again, it doesn't have hot tubs, it doesn't have beach volleyball courts, it doesn't have boat rentals, it doesn't have all these other things that are going to be huge value adds to this multifamily. Will you click to the next slide?
I can do that.
Thank you. All right, so these are some of the smaller comps that would be more of a reflection of what we could expect per unit, right? The best comp that Matt and I have taken a look at to like try and understand the difference between a single family home and then a multifamily home that are hosting the same amount of people is a property in Detroit. Actually, Matt, can you let me share my screen and I'll walk them through just the difference in that property as well?
You should be able to. I haven't set up the multiple can share it. Just Matt has to get off of this share, I think.
Perfect. Okay, can you guys see my screen? Can you see my? Okay.
Yes.
Okay.
Yes.
All right. So here, these two properties here, this one and this one, are side by side in Detroit, and they hold the same amount of people. Well, one difference. So this property holds 15 guests. This property holds 16 guests. It has all the same specs. It has all the same amenities. It's in a similar area. This property here, that is one single family home where everyone's piling into it and everyone's, you've got rooms with bunks and everybody's really kind of crammed in, makes about $170,000 in annual rev. Whereas this property here, it's a triplex and everyone has their own individual space and there is a little bit of privacy. So you get a little bit of separation from your family. But again, you're all in the same building and you're renting out this big space collectively. This one makes over $300,000 a year. So there's nearly a double in income, with the only difference being that you have more separation and more privacy in a situation where it's a multifamily building that you're renting out all in one space. So it's kind of difficult to like have an apples to apples comparison with the properties that we're comping it against on the lake currently and this multifamily unit that we're looking at. But when we're watching similar situations in other markets happen, every single day out of the week, the properties that are multifamily that you can rent collectively are making significantly more money because people are enjoying that extra level of privacy that you get where you get to like retreat back to your own space. It's a little bit closer to what a hotel is like, but you still get that collective, large group situation where you have the amenities that people love about Airbnbs that hotels don't always have. All right, Matt, I will hand it back to you now that I've gone through a whole spiel on comps.
Yes, here I go. 1 second. Okay. Anything left on this slide?
Yeah, actually, I'll talk a hair more about it. So the 4 properties that are on the left are all properties that are holding 6 guests, right? They are the smallest properties on the lake. All of our 2-bed, 1-bath units that are currently in the multifamilies have commercial grade pull-out sleepers. So all of them sleep 6. So we are going to be taking a look at these properties and we're seeing, okay, they're making anywhere from on a low end, 25 grand a year to on a high end, 50 grand a year. And we are in our estimations, estimating our properties to make around 25 grand. So in my opinion, again, based on, apples to apples in other markets, I would assume that our property is going to make more than that. But for, being conservative sake, we're running our numbers at 25. or 32, 42, and 85. So we're on a very low end in comparison to what our competitors are making, and our competitors also don't have hot tubs, you know, all the amenities that come along with higher nightly rates. Okay, now I'm done.
Concur. All right, so here's our comp opportunity. So after 4 years of investing in different areas, we've been outpacing the market, the average local comp data consistently. I wish we could show you, and some people have asked about this in the past, if we could show you that, and we're going to start capturing the timestamps, because unfortunately you can't go back and find that timestamp proof. So we'll have to just screenshot it, and we're going to do that moving forward. The comps available show proof of attraction to the area as well. And it's a general takeaway that they are poorly managed and furnished units. When you get this PDF, you should be able to access a good chunk of the links that are embedded within here. So if you want to do additional research, you're welcome to. The new 2-story bar restaurant, I think, is a really big opportunity. And the developer, I'll add, the history on him says, whenever he's gone into a new market, usually lakefront type of thing, he not only ends up buying a restaurant or retail space and redoing it, he also buys properties around the lake, and most of them end up being $1 million properties. So there's a much greater chance of appreciation. I haven't factored any of that into my valuations and estimates for forecasting. So I'm telling you these things because, well, I think we're forecasting is still reasonable and possibly conservative. So, or intentionally conservative, sorry. And even to Sarah's point, I think there's a need for large families to stay with a bit of separation. I don't know about you guys, but you know, back when we were younger, my family, 30 something of us, would go up north. We'd stay at a multi-cabin retreat. That was like our thing. It was great. But God forbid we're all in the same house. There's always a fight, and we always needed enough separation to get away. So I think this is actually an opportunity that is not really present on this lake, and they've never run this well enough. They have done Airbnb. They said, they let us know, the owners, both the owners actually have let us know they are booked solid. Once it's half decent out, they are just booked, but they've never run it effectively. They've never run it efficiently, and they've only run it for a partial season, which is, I think they've just lost so much opportunity. Even one last thing, Sharon and I learned this lesson on this deal. When you go and you hunt for comps, you don't screenshot it, it could go away. Why? Because Airbnbs and just Verbo, the things that have data, it doesn't stay on year round. If you have a listing and you sell it, or you snooze it because you're seasonally based and you don't want to be coming up through the winter, it goes off. It's no longer a data pull you can pull. So there are some 1-bedroom units that were available that are no longer available, and we wish to God we would have screenshot them. But that general information still showed that we should be $30,000, $40,000 per unit. So keep that in mind. And again, the market mix is largely 3 beds. I think by adding so many 1s and 2s, I think we're actually benefiting the area. And again, by the end of everything, we're gonna have one really nice 3-bed. And if we have it our way, it'll be the nicest 3-bed Airbnb on the lake, at least currently. Let's see, anything else? Yes, we just generally think it's a really fantastic and profitable small STR market in Michigan. So apologies if this might be a little grainy on your end, but this is kind of how we're looking at the value. Here's our count of 1-bedrooms. Here's our count of 2 beds and our count of 3 beds. Here's our low, high. Here's our average for all these. And here's what once you factor in the quantity of what that average is, here's how it's coming up. 502,000, about $500,000. And again, if we go up 10%, it's 550. If we go down 10%, it's that average unit is doing 41,000. Again, we're trying like consistently to not overestimate these numbers, because we'd much rather under promise over deliver, right? And based on per property, this is how it kind of pans out, right? Here's your hail properties, the 1s, the 2s, the 3s, and what those totals are. Here's your long lake properties, the 1s, the 2s, the no 3s on this one, right? 245, 257, there's your 502. Okay. So this is what I was saying earlier, is Long Lake on paper actually makes more money and it's less expensive to buy, which is kind of the irony of this whole thing. But the intrinsic factor is you get 200 feet versus 100 feet of frontage, and you get the storage capacity plus a 3-bed, which I think also puts us more in line with kind of what the norm is on the lake. So I think it's adding additional benefits, plus a significant amount of land, which will allow for more development. So that's another thing that's worthy of note for why Hale is still a sought after property in conjunction. Here's our expected gross over the next 5 years. We did a startup delta, something to say, hey, we think we need to like factor in some kind of handicap for what our expectations are. So we said 25%. We figure, let's call Q1 is going to be a bust. Let's say it's a complete zero. Okay. So that's kind of where we're at. And we're not even factoring in ramping up income year after year. So I think we're, again, a conservative approach with our presumptions. This kind of gives us a nearly $4 million average over 5 years. That average out per year is 477. Our NOI is about 240,000. Again, we gave it a delta of 293 because it's kind of going to be a ramp up. Total is 1.1 million. That averages out to 230,000 of NOI. So now we're kind of getting into how do you take all this information and figure out what's valuable to you, right? What's in it for me, right? So hopefully this starts to kind of make some sense. So we have this broken down. These columns are kind of 1 year chunks, right? So let's say you put in $100,000. We use that as a general marker for easy numbers for calculation. We could take 50,000, we could take 200,000. You kind of know how to figure that out from there. You either divide it in 2 or you multiply it by 2, right? So let's say you put in 100,000 here, and then we collect the dividend, let's say as early as 12/31. Well, yeah, this is you collect this first dividend of that 100,000, which we're expecting about $13,000 for that first year total. Mind you, this will be paid out in quarterly installments, presuming the NOI that we've been talking about, right? Then the following years, it should be closer to 17 or so, and it will probably scale up, but this is just for simple numbers to get an idea of what's going on, right? All in all, the investment cash flow will look like this. It's going to be about 119,000. It's going to be an equity multiplier of over 1.8. An internal return rate of 16.1. We're gonna go more in depth on this. So if you want in, here's what to expect. We don't want you being too caught up in paperwork. We have some pretty easy paperwork. It's more like just voicing your interest. And then from there, we're gonna ask you to fund the investment, and we're gonna do all the heavy lifting. And then from there, it's gonna generate cash flow and eventually a sale. What to expect after investing. We're going to give quarterly reporting, quarterly dividends, and we are anticipating this will be totally passive for you all. Partners from the start. So coming down to the numbers, we're expecting a 7% preferred return. What this means is you as an investor, limited partner, you get paid first. So the very first dollar, the very first $7,000 on $100,000 investment, that money is going to you. We as GPs do not earn anything until you have been paid from the NOI, okay? After that, it's called like a waterfall. After that 7% threshold, you get 40% of all NOI above that 7%. So this is where the additional great upside comes from. So yeah, 7% on an investment is not bad, but this is where it gets interesting. This is where we can potentially double your money. And then at the end of the day, it becomes passive from day one and early. I got to change that. Sorry. That doesn't make sense. Sorry about that. We'll do all the work. So how do I invest? This is how you enter the investment. You indicate interest by filling out this form. This form is a link. Just go in there and you fill it out. It's super easy. It's pretty much a 5-question thing. Who are you? What's your plan? What's your timeline? How'd you hear about us? We're going to ask you to sign a deposit memo and deposit funds. You will not receive that deposit memo and access to the bank account until we've received your form and talked with you about the investment, making sure that you're ready to be a partner in this type of thing. 3, upon closing, we will all sign an operating agreement, confirming we're all partners, and that's when the work begins from the GPs. What does $100,000 get me? Here's the active holding period conversation. First of all, it's the quarterly payouts of preferred return and NOI. Those are the 2 functionalities of quarterly payouts that you'll be receiving. The projected annual return should be about $17,382. A 5-year total of about $86,000. The annual cash on cash, just based on this, should be about 17.38%. I think for most people, that's beating their stock market and most of their traditional investments. If you have something that's beating that, I want to know about it. I'm very curious. The information above only includes cash flow based payouts. So see the next slide for the exit strategy. This is where it gets kind of interesting. So what does the $100,000 get me? And here's what's the exit strategy. So this is called the equity buyout. So after 5 years, depending on market conditions, we will do a buyout. The projected buyout of 102,000 will be based on the $100,000 investment. So what this means is, even if the cash flow, let's say we eliminate the cash flow we talked about in the previous slide, you're going to get your money back in the 5th year based on this alone. So once you add up the previous slide, the 86 or 88,000, was it? 86,000 plus the 100,000, actually comes out to about $188,948, a 1.989x multiplier of your investment. And that's where we came up with the 16.1 IRR. That's the bottom line. So how do, wait, is that the same one? I got to, sorry, that was a duplicate. Okay. So what should I expect? How do I get paid? 7 units are, let's go over this. This is kind of the process of the deal. So 7 units require some renovation, are expected to be operational within 6 weeks of the purchase. They could be up and online probably sooner than that, but we're going to want to go in there and do a little bit of tweaking. 1 to 4 of the other units will be operational by the end of the first quarter. That's dependent on weather conditions and contractor availability. Our goal would be to line up those contractors within a week of knowing the date of closing. Once we know we have the approval to close, that's when we're going to start really digging in deep and getting our contractors in line to go and take action on this. We want to beat that timeline of being, the end of the first quarter. If we can get it done by February, that'd be amazing. It's kind of a lofty goal, but it is possible. So we'll see what happens. And 3, the final unit contingent on seller moving out, contractual obligation is set for June 1st. The truth is, as of today, like I was mentioning earlier, she may be moving out in Q1 after all. So that actually could move up that timeline to our benefit, which means we don't have to have that long of lack of income in that unit. So what should I expect in terms of calculation of NOI? So beginning in Q1 2023, NOI will be calculated and published quarterly. 2, winter months and rehab period are expected to be slower, but our investors will be paid as soon as we have positive NOI. We have accounted, again, I think we mentioned this earlier, we've accounted for a 25% reduction in the first year annualized income expectations due to startup delays, winter, and conversion of the units requiring work. So how do you get paid? So here's the 7% of the annualized 100K. That's the $7,000. Then you're gonna get the 40% above that. That's of the NOI. And whenever there's positive NOI, LPs are always paid first in every quarter. So a lot of you might be seeing some of these terms for the very first time. I'm not going to get too deep into this. I want these definitions to be available to you. So we just kind of wrote some things out for you. What's cash on cash return? What's an equity multiple or multiplier? What's internal rate of return? What's preferred return? What is a waterfall? I want you guys to have access to that because some of these terms are very confusing. And I need you to know that. I need you to be as educated as possible here, right? And coming down to what's the investor operating agreement going to look like? We already have it drafted. We will have it finalized pretty much right at closing. And all of you will have a chance to read the draft once we get the deposit memo signed. And after that, we'll sign the official operating agreement at closing. Once we've acquired the property, we're going to deed it to the entity for holding. And that entity will be named as what the operating agreement will be written as. So that's kind of how that all works. And again, we have another handful of information at the back for commonly used terms. So yeah, that's largely the slide. I'm sure that was a lot for you all. I hope you are still awake and not bored. But I guess I'll open it up to questions now. And of course, Sarah, the board, and you guys want to chime in, you're welcome to. And yeah,
Should I record the questions?
Yeah, I think so.
Okay,
think
I
a
figured
lot
that.
of
I just wanted to make sure.
people, yeah, have the same questions. I
Yeah.
want to reiterate too, I mean, when we're having conversations in here about potentially taking on new partners, we want to make sure that our partners understand that we are aiming to be the big kid on the block, right? We want to compete no matter what in the 90th percentile, which means that we have to put more money in these properties upfront in comparison to maybe what, if you've invested in your own, what you're used to, or what other people are putting into these properties that are already on the lake. For us to be able to create a sustainable Airbnb that's going to make top dollar over 5 years, it requires us to spend a little bit more money up front. And so we always want to make sure that we're partnering with people who have that same vision, who want to, offer a quality experience alongside of making great money. So for us, we don't want to just partner with anyone. We want to partner with the right person. So it's a good experience that we can rinse and repeat. So I always want to reiterate that because we don't want this to be a one and done situation. We want to create relationships with people who really want to continue building a portfolio beyond just this property.
Nailed it.
So without further ado, we will open it up to some Q&A because we spit a lot at you all at once.
I have one quick question that just came to mind. I want to get out of my way. Liabilities in terms of when we have a property that has the waterfront, it has boating activities, it has all these different things that go along with exposure to risk of being on the water. The insurance guy in me goes, how do we cover that or mitigate that if somebody goes out there and decides to jump into the lake or, use one of our canoes to joust and they end up hurting themselves? Like, what do we, I guess, what protections do we need to put in place? Because I know it's been done. But what protections do we need to put in place in order to mitigate any of the risks that go along with having the hot tub and the amenities that are on the water that do have risks?
Yeah. So specifically when it comes to hot tubs and it being on waterfront, those are usually covered by a typical insurance policy that's specific to STRs. We always have to include that with our insurance agents that cover these properties. But when it comes to the boats specifically that are included with a property, those will go under a whole different form of insurance. I would imagine we're going to run them under something like a company called Boat Setter, which is basically the equivalent of an Airbnb, and they have an insurance policy that attaches onto every single guest's rental. So there will be another layer of insurance attached to those boats, and they'll be handled under a separate rental situation aside from Airbnb.
With a waiver of some sort, I'm sure.
Yep, absolutely.
Beautiful. Thank you.
Mhm.
And
Hey,
also
sure.
because we've had challenges with hot tubs where we had a slip and fall with hot tubs, and they sent us a picture saying they're going to sue me one day, and they showed pictures of the beer cans in the background and a 4 a.m. snapshot. So I said, hey, I'm sorry you fell, but the beer cans aren't really helping your position here. But ever since then, we've always said, hot tub, use at your own risk. And by choosing to stay here, you will not hold us liable. We have a lot of things like disclaimers and to kind of mitigate that. And also we can post signs on our hot tubs and at the waterfront. So I think there's a few ways we can mitigate that in general, in addition to the insurance, of course.
Hey, Matthew, this is Michael Chang. I have a question. A great presentation, by the way. I loved all the detail. A question on the 102 buyout or the kind of 2% above cost basis buyout that you have in your model. Is that optional or is that a mandatory buyout at your option?
Right now it's set up to be a buyout. So a lot of things can change in 5 years, right? So it may be a situation like you might have people. Well, let me see. What do I want to say here? It's set up. That is how it's set up right now.
So it's a mandatory buyout. So I guess the question is, we're sitting there for 5 years. There's a stream of cash flow, but then, it's going to be a stabilized property. There's going to be value add there. Are the investors going to benefit from a refi? Even just a refi, I would assume, we're adding value to the property. So at 102, it just seems a little light at 102 after 5 years. But if it's meant to be a floor, like a put, then that's fine. But if it's a call, then it's a little more. Or if it's an optional one, that's one thing. But if it's mandatory, it's a different set of circumstances.
Yeah. So just from the typical I guess, project type that we've experienced, it's always been good to have a buyout option. That doesn't mean that like there might not be an opportunity to stay in at the end, but for illustration purposes, we do need to have this set up like this. So I mean, we can have additional conversations on the sideline, and it's possible. Like let me give you some other examples. Like let's say it's going really well, and the GPs go, hey, you know what? Who's interested in staying in? Who wants to be bought out? That could be a conversation. There's a lot of ways that could go, but generally speaking, for illustration purposes, I've always had to put this in, and I've seen anybody doing similar type of deals. You got to do this for this conversation for the pitch.
We wanted to present a reasonable exit strategy, and that's where we pegged it.
And to be clear, I mean, in a perfect world, we would all either continue running it or reinvest. Our idea is not to get this whole thing up and running and buy it out and be done with it.
All right. I guess the point is like, what if you want to stay in? Then like if you get bought out at 102, then I guess that's kind of this is a great investment. I would love to, if we're in, I would love to stay in longer versus. But anyways, I don't want to later point. That was just a question.
It's a great question, and I think it's something that we can still continue to discuss. Nothing is currently in stone. Let me put it like that. So if you're interested in the deal generally, like obviously, like I guess kind of my pitch here, if you are interested in the deal, reach out to us. Feel free to fill out that form. And I think for, if you have questions or concerns or things you want to hit on, we can go hit on those individually with you guys. And like, for instance, on one of our last deals we did, after we did our pitch, we had people come in, people wanting to come in. We heard concerns, we heard interests. We were able to fund 100% of it pretty dang quickly. And some people made some really great points, and we said, hey, you know what, this is something we want to add. Some things we didn't want to add, and sometimes it works, and it doesn't mean that you and I won't get along or whatnot, but it just means this might not be for that deal. But to your point, there will be deals with us now and later that may be a better fit for, if that's your goal, is just to stay in deals long term. I do think that's a possibility, but it's something we can talk about for sure.
And Matt, just a question from the chat. I'm not sure if I should just say it, but I think it's Ariola.
Oh, yeah. You have until midnight tonight to send the funds.
You moved it later.
Yeah, right.
We got a visit from Frankie coming in later. No, I'm sorry, we're recording this. We can't say that. I'm kidding.
So, great question. And thank you for laughing at my joke. Not many people do. I got an LOL. It's in writing. Somebody laughed. So, the goal has been, we want to collect kind of an idea and interest on this call, potentially get a deposit memo out to you next week and start collecting funds. To be clear, if we collect your funds this coming week, that is refundable. That is not something we're going to hold against you. And if you look me up, Sarah up, you look up my reviews on Zillow, or because I'm also a real estate agent and broker. Let's just put it like this. I have no interest in ruining my reputation or reviews. So I'm not gonna keep your money. If you don't want to work with me, I don't want to work with you. No offense, but I want people to have excellent experiences with myself, Sarah, the board of Mainstay. That is our primary objective. We've had wins. We've continued to grow and cultivate this snowball of like successful investments. And that's where we're ready to take on some bigger deals. And I think people are going to really enjoy having properties run and managed by our group. We're a bunch of wholesome, normal people that I'd say the majority of us started from kind of simple beginnings, and we're doing some pretty cool stuff now. So if you want to do cool stuff with us, send me your money tonight.
So funds will be held, and they are refundable up to closing, right? So after closing, obviously they are not refundable anymore, but at that point we're in it. But up until closing, it's held and it is refundable.
And do we have a closing date? I'm sorry, I didn't know that either. We don't yet.
So while we have a closing date, I know it's going to get extended and pushed back just because of the timeline of these commercial appraisals kind of taking up a little bit of time. And yes, for those of you that are mentioning, You don't want to miss the boat. Well, we haven't bought the boat yet. No, like, yeah, we want you guys to have time to think about it. And that's kind of the benefit of the placeholder value of bringing the money in before we close. So going to kind of to answer two questions, one from Paul, one from in the chat. If let's say we received your money in the next 2 weeks, it is likely we're not going to close until the last week of November, if not the second week of December. So it's kind of like a floating 2-week range of closing dates, if I had to guess. Okay. Once I know we are clear to close, I'm going to go, like if you've seen The Office, it's happening. I'm going to yell, I'm going to scream, I'm going to tell everybody, hey, we have 48 hours here, right? We have 48 hours. I need to know if you're in or not. So I would like all of you to be able to say, hey, if you're planning to retract, I need to know within 48 hours, not even at closing. To Sean's point, yes, it's been by closing, but we pretty much need to know a heads up. You don't get to, if we're closing at 11 a.m. on a Friday, you can't call me at 8 a.m. and say you want out. That just kind of puts us in a bad spot. But I think that's a pretty reasonable ask. If anybody has an issue with that, hang up now. And let's see, yeah, so take your time to think about it. I want you to feel free to ping the board, Sarah, myself, if you have other questions. Is there a minimum investment? We're shooting for a $50,000 minimum. If you can't quite make that, please feel free to reach out and just let us know. In the link for the investor form that you'll get, it will you'll get an option to kind of express what your amount would be or what you're trying to ballpark and buy when, so you can do that. What's the GP commitment? Reading from the chat box, GP commitment is we're already tens of thousands of dollars into this deal right now. Non-refundable money at this point. We've put up for almost $3,000 in inspection fees. I think it's about $15,000 in deposits. And what else did we do? Now the appraisal fees are looking quite expensive. That's going to be over $5,000 just for possibly one of them. Commercial appraisals are not cheap. So that's what we've been doing so far. I think we actually have a slide that kind of goes over what we've been busy doing. I did kind of glance over that, but you're welcome to read through for more detail. 75% open raise. Yes, that's generally these funds of 25%. Yes, that's generally the goal there. Yes, Alicia. And if you go back on one of the slides, it kind of shows you a breakdown of how we came up with that number. You'll see the majority of that. Yeah, the 402 is from the rehab, the furnishing, and any deferred maintenance, repairs, things like that. Okay, cool. Well, that was a lot, but I'm glad we were getting a lot of these questions out. Is there any other questions? Okay.
If there are people on this line, and I'm going to ask this question knowing the answer, so I guess I'm really making a statement. But if there are people that are involved here, this is likely not the last time you're going to hear from us, whether you are going to invest in this deal or not. One of the great things that I found from this exercise was beginning just to build a conversation with people that I didn't realize at the time, or 5 months ago, would be interested in this kind of discussion. As a board, I can say, or as a company, Mainstay plans to do this fairly regularly. And so just know that we're glad you're here and happy that you heard this information, because the next time you hear it, when there will be a next time, it's going to be easier, more digestible, and there may be better timing. And one of the things I've learned in sales is that a lot of times closing a deal is about timing, and this may not be the right time, but the dialogue is open, and that's really the ultimate goal, is to give us a chance to open a dialogue with you on this ongoing, these ongoing things that we're going to be doing to build our company and to work with, people that want to grow their own financial wealth. So thank you all for the time there. That's not my closing statement, but that was just kind of what I was assuming, that we would all be hearing these kinds of presentations in the future as well for the next deal or the next deal.
Yeah. And, I'm not necessarily going to ask if there's any first timers here, but I want to give you an example. For years, I worked as a mortgage underwriter and leader at Quicken, and I was reviewing all these tax documents, these tax returns, right? And what I kept seeing is all these people with these rentals, And after I figured out how much cash flow they were making, how much write-offs they were getting, mind you, this also comes with a major tax write-off, by the way, because this is the last year for bonus depreciation at 100%. So there's gonna be some benefits to, especially if you guys are higher income earners. If you're making over 80,000, I'm sure you're gonna appreciate the benefits of this. But I watched for years. I watched on the sidelines for years, people investing and making money and getting tax write-offs. And I was making 240 to 270 a year in my 20s because I was just crushing it 70 hours a week. But I had to work every freaking day to do that. I was exhausted and I wasn't accruing wealth. I wasn't accruing tax benefit. I had to reset my effort and clock every month just to keep up at that rate. And honestly, it wasn't sustainable. So I finally said, I'm done. I found a buddy. I partnered. My first deal was partnering with my buddy Miles. Some of you guys know him. And we said, we're going to buy a property. And we bought one. And I just got the keys back yesterday and I'm starting to renovate it for the first time ever, turning that to an Airbnb right now, actually. But that property, I just had this quote the other day, somebody liked it. So my buddy made an image for me, but I said, the first rental property doesn't change your life, but it does change your mind. It finally shows you, hey, this thing is possible. You can make money. This can be a good thing. And fast forward years later, I kept accruing units. And then before I knew it, my buddy Paul bought one. My buddy Matt bought one. My dad, who's on this call, he's bought a handful. Sarah knows how that goes. You just start accruing. Sean's been a part of all my crazy chaos. And now he's got multiple units. He's got his own units. A couple other people that are mainstay have them. I probably set up over 150 rental units between myself and my friends and family. All of them do the same thing. They keep buying because they're starting to see and realize the benefit of the tax return, the net income, the cash flow, and it's been generally great. So I hope that if you've been on the verge, I hope if it's not with us, it's with something that you've been eyeing and you want to go for. And if it's not now, maybe it's on our next deal. So hopefully that kind of gives you a good rundown of where we're at and why we've been doing what we've been doing. But it's a good thing to get in, and I've met more and more multimillionaires in real estate than anything. So be a part of it.
Good job. That whole entire last spiel. Okay, guys, so we are going to take this recording and we will send it out to all of you guys. So obviously we went over so much today. So if you want to rewatch it, you're more than welcome to. We also will send the deck that we went through to you guys so you can really take a look at those numbers and digest them in your own time and not when we're speeding through it. If you guys are interested in the deal and you want to take a look at, exploring this further, fill out that form and then reach out to Matt or I or Paul, whoever you are most familiar with, or Sean. And we will have a further conversation with you guys and start getting this property rocking and rolling. And as always, of course, if this property does not suit your current timeline, there will be more down the road. But there are huge advantages to this one, especially tax advantages, because all of that changes next year. So yeah, reach out to us. We'll follow up with an email with all of this. And thank you guys so much for joining.
Thank you. Thank you guys.
Thanks, everyone.
For joining us.
Thanks, everybody. Have a great one.
Bye,
now.
guys.
Thank you.